You won't see it coming. The wall, like a recession is backward looking, right? They tell you we were in a recession. It started last year. What is the safe haven now? Well, for me, gold is the perpetual safe haven. It's always a safe haven through time. I mean, anyone could pick a year and say, well, it lost 30% a year. I get that. As a means of long-term protection for your portfolio, gold is spectacular at that.
The dollar will likely lose 75% of its purchasing power over 10 years, which suggests that the gold price in nominal terms, US dollar quoted terms, could be a triple over 10 years.
Navigating modern financial shifts requires understanding that traditional economic recessions are inherently backward-looking indicators that only show where the economy has been. True portfolio defense depends entirely on recognizing foreseeable hazards and building protection before a crisis manifests in the broad market landscape. Grantwilliams, a renowned financial analyst, and rickrule, a veteran natural resource investor, emphasize that the United States dollar is poised to lose roughly 75% of its purchasing power over the next 10 years. Because of this profound monetary decay, they predict that nominal gold prices are set to triple over this decade-long horizon. While physical gold serves as a perpetual safe haven, many investors fail to realize how heavily manicured government inflation statistics mask real family expenses. Safeguarding your wealth from this decline means prioritizing durable, tangible assets that retain absolute intrinsic value through upcoming volatile cycles. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
Gold is not a speculative asset for me. It's a savings asset. Yes, I would sell it in the right circumstance, but we aren't close to that circumstance. Silver was different. It was a speculative asset. I bought physical silver because silver was hated. And I know that the easy money in cyclical businesses occurs if you have the guts to buy hate. When I bought silver, it was less than $20 an ounce, and people hated it. And my thesis was that over time, that hatred would dissipate and the price of silver would rise. Well, that happened. And when it happened, I needed to decide if there was a new thesis that should keep me in silver or whether I should transfer my speculative capital from silver to something else. When I looked at it, I said, you thought that silver could go to 50. It didn't. It's 75. There's a parabolic upchart. You need to sell parabolic upcharts because they resolve to the downside. Is there a better use of capital? Yes. 50% of the money went into silver stocks. Why silver stocks, not silver? Here it becomes arithmetic. If the silver price goes up, the silver stocks do well. If the silver trades sideways, by definition, you make no money. But the silver stocks were priced discounting $35 silver in a $75 market. So the silver price could fall and the silver stocks could still do well. If the silver price fell because of the discount in the silver stocks, arithmetically the silver stocks would fall less than the silver. Same upside, better sideways, better downside, better speculation. I believe the gold bull market, at least for me, the gold bull market began in the year 2000. I think we've got 10 years left.
Yeah.
So we're in the sixth inning. Understand that in most financial markets, the best part of the move, the hyperbolic move, comes towards the end. I believe specifically, getting the baseball analogy aside, that gold will trade inversely to faith in the US dollar. Faith in the US dollar, because of nominal interest rates, is relatively high now. But the arithmetic around the US dollar is profoundly bad. I believe specifically, and I said this the last time you and I interviewed, that the dollar will likely lose 75% of its purchasing power over 10 years, which suggests that the gold price in nominal terms, US dollar quoted terms, could be a triple over 10 years. Is that US interest rates will stay nominally strong and gold will be nominally weak, perhaps for the balance of 2026. But that doesn't matter. Structurally, the dollar's toast, not relative to the Canadian dollar, not relative to the euro, but in an absolute sense, structurally the dollar's toast. So I'm sort of unconcerned about what happens in 2026. I got plenty of money to get me through 2026. I'm vitally concerned about what happens over the next decade.
Yeah.
As to news, I have found that too many people rely on news because it allows them to feel as opposed to think. It's easier to feel. It's easier to have your motivation be something that doesn't require you to do any work. Mercifully in my life, by the time I was 30, I learned that that was the wrong way to invest. And so I get to compete with people who handicap themselves. The market share of precious metals and precious metals related investments relative to other savings and investment classes in the United States is 0.5%. We are as relevant to the broad economy as a pimple is to a blue whale.
Right.
Okay? The 4-decade mean is 2%. If demand returned to mean, it would grow fourfold. In circumstances like this, reversion to mean almost always means an overshoot. But let's assume we don't get an overshoot. If demand returned to mean, if the market share of precious metals and precious metals investing in a market, the United States, that accommodates 22% of the world's savings and investment assets, were to return to mean, demand would grow fourfold.
What is the safe haven now? Well, for me, gold is the perpetual safe haven. It's always a safe haven through time. I mean, anyone could pick a year and say, well, it lost 30% a year. I get that. But as a means of long-term protection for your portfolio, gold is spectacular at that. And it's done that job for me over the last 25 years. It's been great. The Treasury thing, if you're in the front end of the curve, if you're at 2 years and you're getting 5%, that I think is as close to risk-free in terms of sovereign debt as you can get. It's not as risk-free as it was a few years ago, but at 2 years, I can wait that out. I don't think I won't get repaid, so I'm comfortable with that. And if you can get somewhere around 5% with it, that's great. But elsewhere, again, it's a question of offense or defense. And everybody has been not only conditioned to play offense for the longest time, and offense has been the right thing to play, don't get me wrong. We've had a incredibly benevolent market environment for 25 years, right? It's got squirrely at times, but the backstop has been QE, central bank support, low rates, all those things have always been. And this is where the whole buy the dip thing came from. So it's been a great and benign environment to invest in. And if you believe that that is going to continue, if you believe that everything that's gone before will happen again, i.e. if we do have problems, the central banks will ride to the rescue, they'll cut rates, they'll do QE, and everything will work as before, then you should use the same playbook. Be aggressive, buy high beta equities, throw your money at AI, all those things, right? If you think that the path forward is different, i.e. we will get another crisis, they will try the same playbook and it might not work as well this year, then you need a new playbook, right? And again, coming back to this risk, personal risk, how badly would it affect my life if I lost 30% of my asset? And the answer to that question should be a lot, right? It should impact your life a lot, in which case that's the risk you don't take, right? And we have to be careful now, I think, of making sure that we don't take the right risks. You know what I mean?
The immediate macroeconomic outlook indicates that United States interest rates will likely stay nominally strong, keeping physical gold markets weak for the balance of 2026. However, this short-term price stagnation should not distract serious market participants from the severe structural issues currently facing the global financial system. Cyclical commodity markets offer highly lucrative rewards for contrarian investors who maintain the ultimate discipline to purchase quality assets when they are universally hated by the public. For example, industrial copper prices are predicted to trade significantly higher in both nominal and real terms 5 years from now, provided the economy avoids a total depression. Furthermore, the energy sector exhibits tremendous upside, with uranium values projected to rise structurally over the next 10 years because of prolonged underinvestment across mining industries. Shifting capital into these sectors remains vital for defense. Now, let's get back to the interview.
Risk is different, right? Risk is something you can not maybe exactly quantify, but you can understand what certain risks are because they're foreseeable. You just don't know how serious they're going to be. So I think it's important to, when we talk about how change, the markets are changing, the macro landscape's changing, it changes every minute of every day. It always has and it always will. And so we have to understand that we are going to live with change and we are going to live with uncertainty, whether we like it or not. So understanding that makes it a little bit less daunting, right? But the risk part of that is, okay, it's an uncertain world. What are the risks that I'm facing and how do I do something about mitigating them? They're two different things, I think.
No.
For me, my goal right now is not to lose money, right? I've worked very hard and I've reached a point where to lose money would be foolish, right? And to make money would be great, but primarily for me, I don't want to throw money away. So when I'm thinking about constructing my portfolio, I want it to be as resistant on the tails as possible. I don't need to capture the fat middle if I'm protected against the risks. And so I think accordingly, for me, if I can get 5% risk-free right now in the short term, I'm very happy with that. I'm very happy to take 5% risk-free. No. Whether it's treasuries on certain points of the curve, not too far out, whether it's lending to private companies that I know and understand, not private credit per se in a bucket. My gold position has performed incredibly well. I've had that for a long, long time, and I've just gently added to it over the years, and it's done incredibly well. So my portfolio to a lot of people would be incredibly boring, incredibly dull, because it's not set up to make money. It's set up to protect what I have. For anyone that's looking to protect what they have, they look at mine and go, that's pretty... I was talking to a guy here yesterday who came and talked to me after my presentation. He said, look, I want to ask you about something. He said, I live in wherever, and, my wife and I, we have a ranch, and we have a couple of $1 million in gold coins, and we have this ranch throws off cash flow every year, blah, 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 blah. Am I stupid, or should I be taking more risk? And I'm like, why would you change that? I said, you're set. Yeah. You've got cash coming in, more cash than you need. You've got gold as a hedge. You've got productive land. You've got a house. The guy had it made. Yeah. And there isn't a stock tip in the world you could give that guy that would improve his life. Yeah. Right? All that could happen was he could trash that and make his life worse. So there is a time when making money isn't the primary concern, or shouldn't be, I think.
There's no easy money in this market. The easy money is buying hate. There are structural advantages. Copper will be higher in nominal prices and higher in real prices 5 years from now, absent a depression. Guaranteed. No hate, no easy money, but certain money. Demand for uranium over the next 10 years is structurally higher. No hate, easy money's been made, the certain money is ahead of us. For people who are fully invested in natural resources, they can afford not to buy. They can become opportunistic. They can wait for things to be hated. They can wait for a panic. For people who have 0.5% of their net worth in gold and 99% in US dollars, where the purchasing power of their US dollars is almost certain to decline by 75%, they can't wait. Two things, I'm afraid. The first is that their understanding of inflation is wrong. Americans, even intelligent, learned Americans, believe that a deterioration in the purchasing power of their dollar is measured by the CPI. There's a wonderful phrase that the CPI is the CP lie. I would invite any of your listeners to informally construct a basket of goods and services that their family consumes. Look at the prices that they paid for that basket of goods and services in 2020 and the price that they pay today. The government will tell you that the dollar is losing its purchasing power to the extent of 2.5% a year. The real number for your family is 8. And juxtaposing that 8 to 2.5 should be the fundamental that people use to plan for their future. That's the first thing. The second thing is that there has been structural underinvestment in the means of production for a very long time. That doesn't mean that technology isn't a good place to invest, but you have to understand technology. If you understand a whole bunch about chips and semiconductors and servers, you can invest in NVIDIA. But if you're like me and you can't pronounce it, you can't invest in it. So that's what I would urge people to do. I would urge people to look at the fact that there's been structural underinvestment in extractive industries for 30 years while the economy has grown. And the simple balance of supply and demand means that the stuff of humankind, which gets more used as there are more people, the stuff of humankind is going to be rationed by price.
Traditional investment frameworks centered around perpetual quantitative easing and aggressive equity chasing are rapidly losing efficacy as global markets face generational tail risks. Investors blindly allocating capital into overvalued technology sectors or high beta equities without calculating real downside risk face severe exposure to an impending monetary contraction. Instead, a massive structural shift toward tangible resource production is becoming necessary due to decades of underinvestment in the global supply chain. Currently, the total market share of precious metals and related investments stands at a microscopic 0.5% within the broad domestic economy. Historical data reveals that the 4-decade mean sits at 2%, meaning a simple reversion to this average will cause sector demand to expand fourfold. This massive expansion is further supported by predictions that the currency's purchasing power will collapse by 75% over the next decade, a structural decline that will mathematically cause nominal gold prices to triple. Navigating this immense wealth transfer requires moving beyond daily media narratives and positioning capital where true supply shortages dictate reliable returns. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.